Okay, hi. How are you?
Have a seat.
Hey, Mr. Bennett from Deutsche Bank. What do we have? So how many people have you talked to about this trade?
A few. There's definitely some interest.
Oh, my boss would have my ass.
You know, crazy, Jim?
Not gonna-
Get lost,
Fuck
Jerry.
you.
Which is why you're here talking to us, a wrong number. Sounds like there's a lot of interest.
All right. A few people have invited us in just to laugh at me on this deal. Is that you?
No.
Is that what this is?
That's not what this is. That's just how Mark is. Let's see what you got.
I'm sorry.
You smell that? What is that?
What?
What's that smell?
A cologne?
No.
Opportunity.
No. Money.
Okay.
I smell money.
Okay.
Chris. God damn it.
Sorry.
This is your basic mortgage bond. All right? The originals were simple. They were just thousands of AAA mortgages bundled together, guaranteed by the U.S. government. The modern ones are different. They're private, and they're made up of layers of tranches. The highest level AAAs getting paid first, the lowest rated Bs getting paid last, taking on defaults first. Somewhere along the line, these Bs and double Bs went from a little risky to dog shit. Where's the trash?
Behind you.
I'm talking rock bottom FICO scores. No income verification. Adjustable rates, dog shit. The default rates are already up from 1% to 4%, fellas. And if they rise to 8%, and they will, a lot of these triple Bs are going to 0 too. And that, you're too close, is an opportunity.
Okay, you're saying that at 8% the bonds fail and we are already at 4%?
That's right.
If they go to 8, it's Armageddon.
Yeah, that's right.
How come nobody's talking about this?
You're completely sure of the math.
Look at him. That's my quant.
You're what?
My quantitative. My math specialist. Look at him. You notice anything different about him? Look at his face.
That's pretty racist.
Look at his eyes. I'll give you a hint. His name's Yang.
You're offering us a chance to short this pile of blocks. How?
With something called a credit default swap. It's like insurance on the bond, and if it goes bust, you can make 10 to 1, even 20 to 1 return, and it's already slowly going bust.
10 to 1, 20 to 1? No way.
And no one's paying attention. No one is paying attention because the banks are too busy getting paid obscene fees to sell these bonds.
But wait, you are the bank. I mean, you work for the bank. I bet your margins are pretty nice and fat.
Let's not talk about my margins, by the way. Being nice and fat, that's a nice shirt. Do they make it for men?
Aren't you the bank?
I work for the bank. I don't think like a bank. Big bank, small bank, I like to make money. All right? Let me put it this way. I'm standing in front of a burning house, and I'm offering you fire insurance on it.
How can these underlying bonds be as bad as you say? It wouldn't be legal.
Nobody knows what's in them. Nobody knows what's in the bonds. I've seen some that are 65% AAA rated, that I know for a fact are filled with 95% subprime shit with FICOs below 550.
Get the fuck out of here.
You want me to really blow your mind? When the market deems a bond too risky to buy, what do you think we do with it? Take a guess.
I don't know, you tell me.
All right. You think we just warehouse it on the books? No. We just repackage it with a bunch of other shit that didn't sell and put it into a CDO.
A CDO.
Yes, a CDO.
What is that?
This is where we take a bunch of Bs, double Bs, and triple Bs that haven't sold, and we put them in a pile. And when the pile gets large enough, the whole thing is suddenly considered diversified. And then the whores at the rating agency give it a 92, 93% AAA rating. No questions asked.
Somehow you're like the Dora the Explorer, and you're the first person who has found this thing.
Hold on. So mortgage bonds are dog shit. CDOs are dog shit wrapped in cat shit.
Yeah, that's right.
Okay.
Institutions treat these CDOs like they're as solid as treasury bonds, and they're going to zero.
No, it can't be right. There was 500 billion in housing bonds sold last year alone. The ratings agencies, the banks, the fucking government. You're saying they're all asleep at the wheel?
Yeah. My whole department's long on this stuff. They call me Chicken Little. They call me Bubble Boy. A's, 0. B's, 0. Double B's, 0. Triple B's, 0. And then that happens.
What is that?
That's America's housing market. Thank you.
Fucking A, Jared.
Shut your fucking mouth.
Alright, I had to play that. It was a bit long, but great movie. Watch it if you haven't. I'm sure most of you have. I think I'm gonna rewatch it. Cool. You know what's cool? The guy who was standing in the background next to Ryan Gosling or whatever his name is, he actually commented on one of my videos. The thumbnail was The Big Short, so it probably caught his attention. Alright, so I had to play that because it's very history doesn't repeat, but it rhymes, right? So I played that so you guys kind of understand why rates can't let the rates spike. And this week was a very eventful week in the markets for at least for me. Today definitely was. Today's 25th. It's Thursday. The markets took a huge dump. And the 10-year yield, so the interest on bonds, right, and treasuries spiked. Like very hardcore spiked. Not normal. They're spiking, and it's funny because Powell had a hearing for the past 2 days. Yesterday was the second half. And he reassured everyone there's no inflation. And the bond market pretty much called his bluff. And shit broke. Yesterday, it came out that the interbanking, like the SWIFT system, their repo, inter lending of the banks pretty much broke. All sorts of things broke. And then all of a sudden today, well, the rates have started spiking, right, for the past few days. And I think that's what broke things. And now they really started spiking today. The NASDAQ finally started correcting and it really started accelerating as I told you guys, once the rates really get above 1.45%, so 1%, like 1.5% on the 10-year, it's going to start breaking things. And what happened? It literally started breaking things. That's what I believe happened. I'm not, I don't really know what's going on behind the scenes, but I told you, if rates get above my purple line here, shit starts breaking. And why is that? So the blue line's the 10-year yield, right? I'll just remove some stuff here. The orange is gold. Stock S&P 500 is green. So it's clean so you can see. All right. So I played that intro, right? And now you understand sort of what happened with the housing bubble. Okay. Well, the housing bubble 2.0 is back. It's back. But it's everything now. It's not just housing, it's everything. Corporate bonds, everything. Auto loans, every loan, commercial real estate loans, everything at this point. I mean, we have bubbles everywhere. I mean, we have digital currencies that are worth really nothing. Just in giant. Bitcoin just hit $1 trillion. The entire crypto market's like 1.7 trillion. The CNBC was just talking about selling GIFs, like images, for tens of thousands of dollars, hundreds of thousands of dollars. Everyone has lost their minds. We live in a fantasy world. And everything is a giant bubble. And there's derivatives on top of that. And on top of that. And on top of that. And, you know, Ben Rickards in the movie The Big Short, if you pay attention, he bought a farm and he was like all about gardening. And it's because he gets it. He gets it. He knows how the system's set up. And Brad Pitt played his character in the movie Big Short. You should watch it. That's why they're gonna come out with, they're gonna backstop the market, and they're gonna print another, like, God knows how much money. And soon, probably they're gonna announce something. They're gonna pass a stimulus tomorrow. Then they're gonna, like, over the weekend, probably make up some plans, and then next week they're gonna announce some sort of yield curve control, repo, QE. QE's been going in the background this entire time. It's like 120 billion a month or something. Well, they're gonna have to do something more. And this is the market. This is the bond market. The bond vigilante is pretty much saying, no, I mean, no, there's definitely inflation. There's definitely inflation. It's showing up. It's everyone, when they think of inflation, are thinking about like milk, bread, and eggs. Guys, like, the entire commodity sector is exploding. Except for metals, because they're keeping the lid on that, but not for long. Metals are going to explode. They're just going to be the last to explode. Because if metals explode, they can't, on mainstream media all day, bring on so-called experts and CEOs and this and that fund manager and tell the public, oh, guys, relax. There's no inflation. The bond market's just reacting. This is what they said all day. The bond market is just reacting to, they're expecting a huge economic explosion and recovery and boom this spring and summer, which they're half right. Yeah, there will be. Because people have been cooped up all winter, right? They've been locked down. And, you know, the vax is rolled out. They're going to take off restrictions. People can travel. And everyone's going to be like, all right, it's back to normal. Everything's going back to normal. Everything's going to be great. And that's when the velocity of money is going to pick up. And then we're going to see some serious inflation. But before that could happen, the bond market is trying to price in for that. So I guarantee you a lot of people in the bond market are like, I bet half of them are like, well, rates should go up now because they printed trillions of dollars and we're about to have an economic recovery, so rates could go up. The other half probably no, the Fed's screwed and they're going to have to print more money, and they're stuck printing money, and that's why bonds should go up. And they're both right. Short term, yeah, recovery, economic boom. Longer term, next years and, I don't know, decades, or until the dollar pretty much tanks, they're printing to keep yields down. You guys have to understand, they have to print billions and billions and, I don't even know, trillions to do yield curve control. So they have to print to artificially suppress interest rates and on bonds, because the Fed has to be buying the bonds through the banks. And shit's breaking behind, in the back office. And banks are probably not lending to each other again, which is repo madness again. So then they have to provide even more liquidity for that. And if rates rise, again, the housing market's going to tank because no one could afford homes. And everything else. And then they can't service their debts that have been accumulated. And then, they keep talking about there's a bunch of pent-up savings from the retail investors, like 2 trillion or something on the sidelines. Yeah, true. And it's going to come in, and they're going to use it to go on vacations and go buy things as they think normal's back. And then you're going to see inflation. Maybe they'll buy stocks. Hilarious, right? They're going to... An article came out, I think from Bloomberg. 30% of people are going to take their stimmy checks and go gamble with it on the stock market. This new generation of investors are literally pot-smoking, video game playing millennials who know nothing about economics. They don't know what a balance sheet is. They know nothing. They're just gambling. They're just degenerate gamblers. By the way, video games literally train you to become addicted to like online gambling. Anyways, oh god. So the moral of the story is, this is my theory. Yields are spiking now. Can the bond market beat the Fed? No, because the Fed has an unlimited, as Neil Kashkari said, we have unlimited cash. And they do. So what they're going to do with their unlimited fiat... Oh, by the way, during the hearings, they're talking about the digital dollar. Guys, the dollar's already digital. It's like less than 3% is in cash. So what's the point of coming out with another one? It's the same. It's just repackaged. The only difference is they can see and control everything. But it's the same thing as the old digital dollar, really. Anyways, but now they're kind of talking about rolling it out. I swear to God. The people in charge. And by the way, Powell, towards the end, I put in the newsroom with the timestamp. Towards the end, I think he might actually believe some of the stuff he says about inflation, which scares me even more. I'd rather have them lying than actually believing some of the stuff they say. Because if they actually believe the things they say, I'm telling you, you have to be like Ben Rickards and become a farmer. Like, seriously, start a homestead. All right. So they're freaking out right now, I guarantee you. And as the yield keeps spiking, the market's going to be tanking, especially the NASDAQ. And what's her name? Kathy Wood from ARK, who owns mainly Tesla and then a bunch of FANG stocks, is going to probably blow up. And then that's her Lehman kind of event. Or if not her, someone else, or maybe a bunch of them all at once. And you're going to get 1.9 trillion stimulus for COOF. You got in the background running 120 billion every month. Then they're probably going to up that up to who the hell knows. I don't know, 500 billion, half a trillion, every month? and then QE on top of that to stop it. Because listen, as this thing pops, it's going to take more and more stimulus. It takes multiples of more stimulus to reinflate the bubble. So I'm thinking like, here's the NASDAQ. And TA-wise, just TA-wise, it's really weird. TA always like lines up with events that happen. Can the NASDAQ dump to the 200-week moving average? Which would take you to like, I don't know, like 9,000 or something. Yeah, but it would be really hard to reinflate it or to... I mean, I feel like just if that would happen, something like that, a serious deep correction like that, like Kathy Wood, like all these hedge funds, everyone would just blow up. and there is no reinflating that. So I'm thinking I don't know. I'm thinking somewhere around 11,000. They might let it fall that far, the NASDAQ. And then, plunge protection and QE, all sorts of craziness is going to just come out. And the Fed's balance sheet's going to explode. And that's right before the spring and summer where the recovery back to normal is going to be playing. They're going to be playing that song all spring and summer into probably winter, into 2022. And that's what I'm counting on. So maybe another 10%. I mean, NASDAQ fell what? It's only fallen in retrospect. It's nothing big, but this is why they shit themselves, because they know it's a bubble. Today, MSN on the media, they weren't really that worried. They didn't seem worried at all. Maybe it was an act. I don't know, but they should be. It only fell like 8%. The NASDAQ. That's nothing, right? It is something when it's a bubble, because you never know when it's the one that's really going to start triggering things and breaking things. And I'm telling you, something broke, right? Because this time it's a little different, because the yield on the 10-year is spiking so quickly that could be like the needle or the bullet that's going to blow this bubble up. But I'm telling you, like, if the NASDAQ even falls to like 11,000, they're going to freak out. They're going to do yield curve control, and they'll print $1 trillion to do it. They have to. If they don't, then yeah, this is the big one. In my inverse ETFs that are short the market, which is really hedging all of my gold and silver mining stocks, exploded today. Like huge gains. And I have to do that. I have a margin account. It's smart if you have the money, right? Because you need minimum like 25,000 because of pattern day trade rules. It's smart to have two accounts. One, this is talk to your licensed financial advisor. I'm not a licensed financial advisor. These are my opinions. It could be wrong. I'm just some dude, okay? I'm just talking out loud. But consult your licensed financial advisor before you do anything. But this is what I do. I have two accounts. One's for trading, and one is for my core positions. Although sometimes, if I get too greedy with my trading account, I have to transfer capital from my long-term core position account to my trading account. And I do that as a strategy because I do very aggressive trading. I leverage up. I use leverage ETFs. Then I'll use options. And if I blow my account up, at least I'm not going to take out my core positions, or it's not going to eat away at them. And I don't want to sell them for tax purposes, right? So I separate the accounts. I think they know. I think Powell know. I think Powell isn't afraid. The people at the Fed and everyone on Wall Street, I don't think they're as afraid of inflation as they should be. But I do think they all know it's a bubble. Everyone knows it's a bubble. But they're not really afraid of inflation. And this is what they don't understand. The reason is because of the velocity of money. If the banks start lending to the peasants so they could go and buy homes and everything, then there won't be inflation. BS, there will be. Because the central bank, the more they try, right? Hold on, let me bring it back. The more they try to do yield curve control and stop the bond market from pushing the yields up by selling bonds, right? So the more bonds the central bank has to buy to keep yields down, the more currency it has to create to do it. And the bigger the balance sheet becomes of the Fed. And that is directly monetizing the debt. That is no different from Venezuela printing money. And at the same time, I mean, we just went through an overhyped, cold season in the past year, and we literally destroyed 40% of the small businesses that were left in the U.S. We have no manufacturing base, and everything is financialized, and it's all bullshit. And I don't know, man, like, what are they doing? I don't even think the ruling class, like, you could say you could say it was sort of planned, right? And they did it to consolidate wealth and everything. Okay, but when the music stops, I mean, what do you think? Like, it's gonna be Mad Max. Seriously, like, the balance sheet, it's gonna be over 10 trillion by the year's end. Who knows where it could be. I mean, just in the next, like, 3 months, they're going to do, like, 6 trillion? Because they're going to do infrastructure spending on top of all this as well. Maybe they're letting rates pop a little bit because they're worried about the velocity of money turning up this spring and summer, which it will. And let me show you. Here's M2 money supply. M2 money supply is, give you guys definition. All right, M2 money supply is a calculation of the money supply that includes all elements of M1. There's 6 M's, okay? M1 as well as near money. M1 includes cash and checking deposits, while near money refers to savings deposits, money markets, securities, mutual funds, and other time deposits. These assets are less liquid than M1 and not as suitable as exchange mediums, but they can be quickly converted into cash or checking deposits. M2 is what to look at. Here's M2 on a chart. Okay. What color is M2? M2 is the blue line. It's like money in the economy that everyone has. The orange is gold. Gold has to catch up with the blue line, which is M2 money supply. And this is about to go straight parabolic in this year. It's going to go like straight up. Like another, like, who knows? Like, let me take this off auto here. It's going to do like something like this. It's going to just like, wee. All right. This is insanity. And then gold is going to do something like, oh, I need gold and silver. This is why there will be a short squeeze. We need to catch up to inflation now. It's going to do that. It's going to be like parabolic. Okay? And the people who keep screaming, no, you don't understand how all of this works. There won't be inflation because there's no velocity of money. There will be velocity of money. Let me put it back to percent and auto. And it doesn't take much velocity of money, by the way, for this to happen. This yellow line on the bottom here with the blue area shaded, that's the velocity of money. So if we zoom in, okay, we zoom in, you can see in 2020 the velocity of money here just dropped off a cliff. Meanwhile, they printed a shit ton of money. It went straight up. And then, let me, again, show you what's about to happen again, because they can't let the stock market and everything bubble pop. So they're going to print even more money. And then here's the rest of my blue line. It's going to go like straight up. Maybe that's a little exaggerated. Okay. It'll do this. Just another like leg up. Okay? Okay. Well, the velocity of money is going to pick up again. It has to. Like, return to somewhat normal in shopping and everything has to come back. If it doesn't, the peasants will get the pitchforks and the torches. They have to feel some normality coming back to their lives. Okay? That's and then velocity of money is going to pick back up or just go back to normal. More than likely, these stimmy checks and the fact that the stock market is just going to keep going higher because they're going to print trillions more, boomers and people are going to take some profits and they're going to spend that money and they're going to do things with it. Go on trips, buy more RVs, I don't know, a second vacation home, something. And then all of a sudden, velocity of money is going to pick right back up. Let me make this yellow. Okay? It's going to do this out of nowhere. It's going to do this year and next year. When this happens, all it takes is just a little bit of the velocity of money to come back. Or at least get back near normal. Okay? But I have a feeling it's going to overshoot it. Because people are now addicted to stimmy checks and all this extra welfare, unemployment benefits, because they're making more money off of unemployment benefits than they used to just working their shit jobs. But now those jobs are going to get replaced with robots and automation because they just hiked the minimum wage, which makes it even worse. And then they're going to keep doling out the money because if they don't, the pitchforks and the torches come out. It's that simple. So the velocity of money is going to pick up. People are not going to have anything better to do, a lot of people, than shop. It's going to pick up. And when it does, this M2 money supply, man, it's going to explode. Well, it's already exploding. I'm saying the velocity of money is going to explode. And when it does, inflation's going to explode. And when that does, our mining stocks they're just, it's going to make cryptos look like bonds, I think, in the end. So that's exciting. What's not exciting is society. I mean, society. Although they're pretty, I don't know. I don't want to go down. So, very exciting. By the way, what's his name? Bill something Murphy, or is it Bill Not Bill. The guy from The Big Short. He shorted Tesla, and it's hilarious. Peter Schiff. So Peter Schiff. He was tweeting about I don't know, probably crypto, and then Elon Musk responded to him, and then Schiff, here we go. Elon responded to him with a eggplant emoji, calling him a dick, probably because Schiff was right, but his response was also that that said, BTC and ETH do seem high, LOL. And then right after that, the crypto market had a huge correction. But and MSNBC keeps talking about Elon's tweet, but they won't mention that he was responding to Peter, because Peter Schiff used to be on CNBC and all these mainstream media, networks, but they don't have him on anymore because they can't have Peter really talking about what's really going on and pointing out the fact, what's really going on, everything I just said, and, talking about metals. I swear to God, every time someone even mentions gold and silver, like the anchors, it's almost like a chill runs down their spine. Like, we can't talk about that. I don't know, guys. Stay away from these pump and dumps. By the way, with the GameStop stuff, listen, there's a lot of bag holders, and they're pumping it again. And there's a lot of bag holders who are probably looking at that and they're just trying to get out. So they're not going to be able to pump it like they did last time. And again, why would you try it again on the same thing? You know they're going to halt trading on it like they always do. Unreal. I thought this was very awesome. Okay. Never mind. You guys can watch. It's on my Twitter. It's on my newsroom. Links below. So, it's insane times. We're living in insane times. Again, there's a bunch of news coming out on the silver. Possible short squeeze. I've talked about why silver is super undervalued, in my own opinion. One is, I really do believe they've been suppressing the price for like literally a decade, and that for good reason. All these companies need the metal to produce cheap goods, like your laptops, everything electronic, EVs, solar panels, you name it. The second reason is it's also a monetary metal. If silver goes up, gold goes up. If gold goes up, then the stock market freaks out because they're like, why is it going up? Because it is the ultimate insurance policy against everything. Because when you live in an everything bubble, the only safe haven is literally that shiny metal. Why? Because it's made during a supernova. A supernova is a star imploding on itself, and we cannot replicate that and make it. We cannot make gold and silver. And then those metals fell to the Earth's surface, and then the metal came together in deposits when the crust was molten lava, and then it created veins within the Earth crust. But because of the suppression of silver, all of the easily mined silver and gold has already been depleted or mined, and now it costs a ton of money to keep going deeper in extracting it from the Earth's surface. And listen, I know there's a lot of mining companies who know this as well, so what they've been doing is not really selling a lot of their reserves. They've been sitting on it and waiting for the everything bubble and the Fed to keep printing money and for the next bull market. So Wall Street doesn't know that. I know that. I'm telling you, these mining stocks are priced literally at $1,200 gold and like, I don't know, $11 silver an ounce. And when gold and silver could like go to who knows? I don't even know. $50 is like bare minimum. I wouldn't be surprised if it went to like 100, 150, like real quick, and then higher. And then gold goes to like 3,000, 5,000. And then these mining stocks would be doing like, I don't even know. You're not going to believe it. That's what I think will happen, evidently, in the end. That's why they suppress it so much. But they're going to lose control. It's inevitable because eventually Elon Musk and all these corporations have to buy the metal, and then there's going to be a physical shortage, and it's already happening. And then the only way you can gain exposure to it is through mining stocks and ETFs. Guys, smash some likes. Join the private group. I'm probably going to, join the private group. Links below. Go to my website. One-time fee, and then it's $20 a month. And then pay for itself. It will very soon, I believe. This spring and summer, I think we're going to see fireworks. I could be wrong. Consult your licensed financial advisor before doing anything. Subscribe. Go to all my social medias, and leave anything in the comment section. I do respond to them, unless you said something dumb and I just banned you. I don't know. We're living in very interesting and exciting times. I'm gonna go watch The Big Short and relax. Peace.